Let's go to the next thing, because I want to talk about foreclosures. So foreclosures are interesting because they are still below pre-pandemic levels, even though we have higher interest rates, even though we have higher house prices, even though we've had inflation competing for everyone's dollar every single day of the week, every single where they shop and buy things. Plus, here's the other thing. We've had, and you've said this before, and this is where I agree, we've had much more stringent underwriting standards over the last couple of years than we did in 2008 and 2009. All the stuff prior to that, 100% financing, no money down, conventional, no income, no job, no assets required, credit score only, yeah, that's super risky. That's not what we're in now. That's not the environment. 125% cash out with a HELOC second? No one's doing that. So the foreclosure risk I see now is very much more subject to just the person's economic situation and their finances, not that, and the fact that the market is rife with products that are about ticking time bombs.
No, absolutely. But I like this one, kind of puts a little bit of doom and gloom right there, right? But at the same time, it gives us good information where it's actually not so. And the reason why I say that is because what's actually giving the whole doom and gloom is out there in the media. It's saying like, hey, foreclosure are all-time high. They're coming up, all this is happening. But when you really look at it, and the article actually specifies there that we're still below pre-pandemic, so which is just great. And what's the reasoning behind that? The reason is because we still have people who qualified with utilizing their income versus back in 2008 and all that stuff, that it was just kind of like you had a heartbeat and a great credit score, you get a loan, you're good. 2 thumbs up. Yep. And a house.
Well, and I think in this case too, you have, even though people may have gotten a 3%, 3.5%, 4% on the refinance, like, oh, the interest rate's so terrible now. Well, not to them.
Yeah.
So it's not terrible to them. So as long as their economic situation hasn't changed, they're still able to make that housing payment, which means you're not going to see that foreclosure unless something else happens, unfortunately or unexpected in their life, that they're not financially prepared for. On top of that, you have way more equity now than you did before, because people were getting into the market at the peak of the market at 100%, and then it went down and collapsed because of what was undermining and eroding the financial system as a whole. But now we have so much equity, highest ever on record. Well, that means if you're in a pinch, just sell your place.
That's it.
Oh, and you have to sell your place? Fine, more inventory. Oh, which we have demand for. So guess what? It's all going to work out. I don't think we're going to fall off a cliff and then just hit this ravine down the bottom.
Yeah, that's what I was going to say. I mean, I was not originating back in 2008, 2006, 2007 area. But what I do see now, and I feel that, looking back at history, is that there's more exit strategies nowadays. I mean, I'm not sure how wholesaling, sub 2, and all this other stuff was doing back in the day. But nowadays, there's multiple ways to get out of your property. You could sub to it. Someone else could take over your payment. You can, wholesale it. Someone could come in and, still get rid of it if it's in bad condition. So there's multiple ways. And then, Andy, you brought up the point. There's so much equity that, foreclosure is goddamn like probably the last option before you actually get in there, unless you're like in a very financial rut. But then there's still so many safe rails, guards in place that, avoid foreclosure. Like, I feel banks nowadays would rather help the buyer stay in the house because they want to continue, getting that monthly payment rather than going and putting it up on the market and saying, hey, now I'm going to sell this house, take a loss, and then now we all lose.
Yeah,
that's very true. People do have an exit strategy. The main exit strategy right now is that they hold a certain amount of equity where they can utilize that, sell it, pay everything off. I mean, we had a client that was, pretty tight in income. He had a second property, an investment property in Las Vegas. And, his credit actually was going into shambles because he lost his job and he was just struggling. Like, how do I pay that debt off? And so one of our advices is like, sell that Vegas, and we analyze the data, right? What's your payment? What are you collecting in rents after you pay off the property management company? So he was just left over a couple $100.
Yeah. It makes sense.
Is that really worth it? And you have tied up like $60,000 of equity in there. The best thing in that situation, sell it off, pay off that high credit card debt, and then later you're going to rinse and repeat.
Yeah. I look at it kind of like an athlete that gets hurt on the field, and it's like, hey, you might need to take a week or two off, but then by week 3, after you've been injured, you're going to come back and you're going to be strong again. So you might just need to take that temporary pause where, yeah, you might have, hurt yourself a little bit. Okay, but that doesn't mean you lose your position on the team. You still got a primary house or even a primary and a second, and you got to sell your third or fourth, whatever it is. Even if it is your primary, okay, cool. Maybe you got to go down to the minor leagues. You come back up to major leagues again another time, but at least you can leave while wiping out some debt, removing yourself from the the threat of foreclosure. And again, and the reason we're so adamant about this is because there have been times in the past where people have called us or told us that their situation was dire too late in the game for us to do anything. So while it's early, if you have a situation that is threatening that you could be facing foreclosure, there are things you can do about it before you get that far down the road, and that's your only option, because your silence will not help you in this situation. Speaking up, asking for help, getting clarification is going to be your best friend, and selling might just be the best way out of the situation.
And I think a lot of people are, we see the job labor market at its lowest. Right?
You mean unemployment?
Unemployment is just one of its lowest. I mean, that's great. That's why we haven't seen interest rates, go down also, because that has a huge impact as to where interest rates go. The situation here, what's happening is, I think a lot of people are going into in certain problems is because now they're coming up with apps where you can finance a burrito, right? You can finance your food. Yeah. All these things where people are seeing is, and we saw this early in Washington, to buy a slice of pizza, it's $8. It went from $2 to $8. Everything is costing more, even though our inflation's down. It seems like inflation hasn't gone down for us consumers. Mm-hmm. But, our government keeps saying, no, everything's consumer confidence is good. It's not.
It's offset. It's one thing that's up by 20%, another thing, and then there's one item that's down by 20. That's down by 20. Okay, so it's neutral. Well, no, because you have to look at it like in more specifics, right? And I'm not defending the government. I'm saying that overall inflation can be slower than it was before. It was like at a 9% clip 3 years ago. Now it's like at 2.1 or something like that. Okay, that's better. But we didn't go from like +9 to like -9 to get back to where we started from. We're like +9 to, okay, +3, +2, +2. Okay, so we're still up there. We're elevated. But my issue is that you have to, like, it's nuanced. Some things are just more expensive than others when you look at the tail of the tape. And CNBC, who I disagree with most times, there's a lot of things that they actually do when it comes to the inflation report, where it shows it like industry by industry. That's and crazy. Some of them are like 30% up, and then some are like 20% down. So when you look at it in the detailed fashion, it actually tells more of the story.
Absolutely. The reason why I bring that up, because it says here on the article, credit data in general doesn't look great when accounting for credit card debt, auto loans, and student loan debt. All have increased in their percentage on 90-day lates. We're all late. Like, these debts are crazy. And so I was looking at, what is the national consumer debt right now? We're at $18.04 trillion. Jesus Christ.
What?
Yes. Last year, we were at 18. We were a little lower than that. And so I wanted to just have a breakdown. So mortgage debt accounts for $12.8 trillion. Which is pretty crazy. And then we got student loan. Get a load of this. $1.63 trillion.
Wow. Dang.
We love giving loans to our kids, right? This is what it's all about. Get these kids in debt at a young age, which is pretty nice. Auto loans were at 1.64. Credit card debt at 1.18 trillion. We're talking trillions. Home equity lines, which is pretty nuts. I thought that would be way up there. Guys, it's only at $402 billion.
Did you just say only $402 billion?
Well, in comparison to
I know.
everything else, it's not as important, right?
I'm just being nerdy.
Yeah.
Just listening to that gives me chills, because the most, how do I say, the things that you need to survive, the things that you need to excel in life, the things that you use day in and day out. You live in a house, you need education to learn to get higher, further in life, and then you need a car to get anywhere. And those are the things that are, weighing down on you the most, which is the things that you probably, use the most.
I was pretty astonished when I saw the number breakdown.
So what do you guys think as far as your prediction? Do you think we're going to see more foreclosures in 2025, or do you think we're going to see less?
If things go the way they're going right now, Andy, I foresee there's going to be more.
You do? Okay.
Absolutely.
So you don't think people are going to sell and kind of pull the eject button? I think a lot of
people, it's like, and we've been seeing this. I've actually been, we talk with a lot of realtors. We've been seeing a lot of what's called a BPO, a broker price of payment. Yeah. That's right before it goes into foreclosure. A lot of people just get that sentimental value where they wait to the last minute until the bank just comes and takes over. We've been saying a lot of that. We've been hearing a lot more below modifications out there. So these are the talks that are happening out there. People are wanting to stay with that lower payment because their money, their job, their income is not producing enough for them to justify them keeping this home and all the other debt.
Yeah. Okay. What do you think?
I think people are going to sell. I
Okay.
think people are going to
Of
sell
course.
before they foreclose, unless they completely like lose their job from one day to another. But even then, you can still just put your house on the market and sell it in 30, 40 days.
Yeah. I think the difference between people selling and people like holding on with a grip of life until the very end, it really comes down to just, I don't mean pride in the arrogant way. Just like, I don't want to admit like I'm going to take this loss, you know? You know, there are circumstances, of course, where foreclosure is just what's going to happen, and because there's not another way out. And yeah, they bought a house in the last couple of years, so maybe there's not as much equity. I think it's just a lot less than it is compared to 2008.
Absolutely.
Like we're comparing in articles once again. So I don't think that's really I don't think that's a fair enough assessment to the common reader who isn't in these seats on the front lines every day like you guys are.
I think there's so much going on that, you know, you can't just generalize it. Somebody could be in a completely different situation.
That's what I'm saying.
Yeah. So it's kind of like, I would say like smart decisions sell, but
Well, this is what's happening, right? What we're not hearing right now is one thing that we learned with the pandemic is what were we doing for the consumer? Doing loan modifications, and then what will we do with the balance forbearances for 12 months? Then extended 2 years, right? So what happens to that balance that was not paid? It gets refinanced and gets tacked on in a loan modification. What if nowadays the value isn't there because they've already used some of that and now they're experiencing the same situation?
Yeah.
Right. And that's what I'm talking about. Those type of foreclosures that we're gonna start seeing because it's like you don't have much in there already. We already tacked on prior to, and now we're tacking on more.
Those are those same ones I'm saying. Those are the ones that if they did buy during that time and they did that tack on, those are going to be the ones we probably see. It's not going to be the people who got a 40% house price valuation increase and now they didn't touch any of their equity. They have tons of equity they're going to sell. So there's that marginalized, I'll say more marginalized group. That you're right. You're 100% right, though. It's going to get paid one way or another.
No, and we're going to start seeing it. Texas, we got with the wholesaler. What are they doing? Loan modifications for a lot of VA. It's happening. I mean, we're seeing it over there. Why in Texas? Home prices have gone down a little bit. They're still kind of there, not gone down drastically, but there's just a lot of inventory out there, right? The other thing that they've been experiencing is higher property taxes. And then insurances are going up. As a matter of fact, insurances on January 1st for California, we've also been experienced quite a bit too. And also has to do a lot with these fires that came. You know, these farmers insurance, they don't have enough.
the bills come due.
Right? They don't have enough to sustain themselves.
I know I didn't bring it up, but I think their 17% increase got approved.
Yeah, it did. It's been all over.
And we're going to have to probably talk about that on another one.
Something else.
But that's it. Yeah.
But yeah, 17% starting January 1st.
Yeah, these are those all competing factors I was talking about at the top. It's like, hey, something's got to give, right? And ultimately, yes, will there be foreclosures just by default because there will be more? Yes, there will be. Will there be people that can sell so they can get out of it last minute? I think there will be as well.
No, absolutely.
Yeah.
I don't think we're going to see foreclosures like we did in 2008.
No.
That's just not going to happen.
We're not there.
That history won't happen.
We're not there.